Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn Associates for this Wednesday, the 9th of January, 2019, and we're after the 2:20 p.m. Central Standard Time. This is your agriculture update, and as you can see, a positive day in grains, but not at the top part of the day's range. You were up more than that, but the market seems to have stalled out. Certainly not a lot of volatility in those markets. There's help in the way of a much weaker dollar, which is supportive to a number of markets, be it the energy markets that are over on my side here, be it the metal markets, the stock market. The Fed notes came out, and the Fed has got the markets back. It's changed its opinion. Just read those notes, and I'll write about it in tonight's report. But as we take a look at soybeans, to me the question is, on a weekly chart, can we get up and close over the 916 3/4 zone? Now that's 5 cents away, but it's the last rally high. We've had a correction. I wouldn't want to see the market then slip back and take out the lows that we saw last week, close here under 882 3/4. And I'm not saying that'll happen, but it would make the market look like it's got higher highs, lower lows, and headed back into that 18-week moving average of closes. When we take a look at the sideways action here, we're getting some distribution of price, and you see that when you put the swing line on. You do have the pattern of higher lows and higher highs. Now what will hurt the market, let's first go there, is taking out 914.5, because if you don't take out 927 3/4 first, you would end up with lower highs and lower lows. So the number a bull wants to defend is not letting that number being taken out, and then they obviously want to see the market start marching to higher prices. Unfortunately, the chart setup is one where bigger support lies underneath that, back at the 18-week moving average of closes at 908, resistance all the way up at the upper Bollinger Band. So this market's got to make a decision. Does it pull back a bit right here for the support back at the 18-day average? Even if you take out that 914, until you'd close under that, you wouldn't have a bearish setup. Or is it strong enough to make another surge to the upside? The problem is it's spent so much of its energy. It's overbought as can be right now. It's already seen the trade delegations come back from China. I have not seen a formal announcement yet from the Chinese or the U.S. They're going to coordinate one, but apparently they've made some progress. Problem is, are we going to see more soybean purchases or not? The Chinese have bought that 5 million metric tons, and with the government closed, we don't hear too much other than from the grain trade itself, not from the government on what's going on. In the meal market, you finish the day out at 323.40, just over the Bollinger Band top of 320.20. You're hugging that as you're moving higher, but again, overbought condition. It's moved a lot already. Unlike the beans, it can afford a heck of a bigger break. In fact, they can go back to 314, not honestly do any damage to the pattern of higher lows and higher highs as to how it's set up. Soybean oil is more like the soybean market. It's got now the pattern of higher lows and higher highs, which is bullish. The market is over the 18-day average, which is bullish. The market's got upside momentum, which is bullish. So the only thing that can negate this right now, the way the chart has now come about, is taking out the 28.21 level, which could then issue a pattern of lower highs, lower lows, under the 18-day average of closes, which would be bearish bias and probably kill the upside momentum. That's the number you don't want to take out. Resistance back at 28.82, the 100-day moving average of closes. The corn market's in a pause. What that means is you had an outside day, now you're trading at an inside day's range. You still have a pattern of a lower lows, if you will, and a higher high. Very difficult to make anything out of that. I see two levels of support, be it the 879 and 877. Did I say 379 and a half? Boy, I wish that the corn was eights. 379 and a half and 377 and a half. Those are the two spots that I'd see as support. If it can clear this high of the 341 and a half zone, there's no reason not to think that you can't get up to that upper Bollinger Band as you make a run through there. And let me just check that high. It was, did I say 3 to 1? I'm not seeing well. It's 384 and a half. I knew something didn't sound right. In the wheat market, wheat is basing out against the 18-day average. It's hit it now 2 days in a row. It still has the pattern of higher lows, higher highs. The bulls don't want to see 313 and a half taken out, and if it can clear this 524 and a half level, why not make a run for the 100-day average? The upper Bollinger Band's pretty far away, but you've got the bias up, you're over the 18-day average, the trend is up, and momentum is pointing up. In the sugar market, I've been telling my subscribers in the morning, be very careful. You're at the area where there's probably profit taking place. You've been here before, done this, and this is the zone that it's happened each of the times. Now the difference now is that the market stayed over the 18-day average successively for 3-4 days. That's good news. It also brings into play that we have support, a double area of support at the 100-day average and the 18-day average of closes. The dilemma is if you were a buyer there, you've got to risk all the way back under the most recent low of 1169. That's a heck of a lot of risk. I don't know what you're going to get done there. In the coffee market, I think I've pointed out that the market's trying its darn best to stay over that upper Bollinger Band, but I doubt that it can just yet. The market's pushing on it, but it's overbought. Overbought is so often important. You know, you can convert overbought to embedding, which means you then get more power to push. But when a market just freshly hits overbought or oversold against a Bollinger top or a bottom, it's often a sign to use a lot of caution. What you want is the embedding. See what happened when that happened? Prices went down. So momentum often leads price, and you look at that. In the cocoa market, we have what's called a corrective move. Now, why do I say corrective? Because as long as the market stays over the 18-day average of closes, I keep an upside bias to the market. That is my line in the sand. Momentum, which leads price, has turned down and lost what we call the bullish momentum, the embedded reading a couple of days ago, and I have been expecting price and the 18-day average to come together. Now, if prices close under that, then the question is, does it get further momentum to drop to the 100-day average? But until it's under there, you've got a very neutral market that's in a corrective phase. In the cotton market, I want you to look at today's close here on the slow stochastics. That's called losing the bearish embedded reading. Take a look right here. You see that? You were embedded all the way through. You didn't lose it there. Today you lose it. That often leads to price and the 18-day average coming together. You know, tomorrow we have our live chat room, our webinar, if you will, and it's at 12:30 p.m. Central Standard Time. If you didn't get your invite, call my staff to get one. And why? Because these are good questions to bring up when you see these. I use this even when I look at individual stocks. Why not? A chart's a chart. What's the difference? Take the name off it. When I teach in my charting course, I tell you, throw the name off the chart, because anything you read about cotton or gold, it's going to sway you. You can't help it. It's just the way that it is, and you want to become more of a chartist. In the cattle market, I'm going to stick with what I said. It's almost impossible to trade a market that goes from Bollinger Band highs to Bollinger Band lows, back and forth. Where are you going to come in? What's your risk going to be? Very, very difficult. Overbought, upside bias. Don't know what to do with it. And by the way, that's something you have to learn on a chart. You have to learn, if it doesn't look good, walk away from it. You don't have to be in a market, on that market, each and every time. Feeder cattle threw out a surprise today. The market closed the day at 144.90, which is under the 18-day average. In the process, you've developed now lower highs, lower lows. So the bears took control of the market unless the market gets back over yesterday's high, and that number was, as we can see here, 146.47 and a half. Barring that, potential is the lower Bollinger Band. Momentum is flat, not pointing up, bias down, trend now down. In the hog market, hogs got a good pop today. Hope for China news. I'm guaranteed that's part of what's here. And it went up to what? The resistance point. If we knew nothing else, just like this. We're looking at a market that at this point had lower highs, lower lows, then it gets a pop-up just through that number, so you neutralize. Where's the resistance? What else? You had lost the embedded reading right here, so the 18-day average was the target. You got there. What's the next resistance? The way that I teach charting, the 100-day average. You tell me where the market went today. Where's support if you pull back? The 18-day average. Do we have a trend? No. You have a lower low, higher high, upside bias, and upside momentum. You put it all together, you try to come up with a game plan, and I have one for you in silver. I wrote my silver report yesterday. I'm glad silver's up today the way it is. We'll see if I'm right or wrong on what I've been saying. And in my reports, you get a series of charts. I let the charts do the talking. I'm not going to this year write fundamental reports on why this should happen, why that should happen. Let others do that. I'm a chartist, and I think I can make my arguments. I didn't use a price comp, but I used all the rest of this, the seasonals, the weekly, the daily charts, to give you an idea what I'm seeing. If you didn't get an invite to read the report, then you're not on my list. So what do you have to do? Well, the thing to do is give my staff a call, or go to our website, sign up for the report, and you'll be certain to get it. Call or go to www.iraepstein.com. We'll get it in your hands. I'm Ira. Remember, if you haven't already signed up for the chat room tomorrow, it's at 12:30 p.m. Central Standard Time. It typically lasts about 30 minutes. It's totally free. You're welcome to come in, bring questions. That's what I want from each person, questions. I'll do my best to answer. You have a good day. See you tomorrow.